the GoToWebinar application, and we'll do that and we'll answer those as we go. Today's webinar is all about understanding the key relationships between profit and cash flow, and understanding the importance of those and how you can improve the performance of your business, both in terms of profit but also in terms of cash flow. Very important. Right, so in terms of what we're going to go through over the next 45 minutes or so, we'll have a look at what all the fuss is about in terms of budgets and P&Ls and cash flow. We'll have a look at the difference between a P&L budget versus a cash flow budget. What you'll see is that there are two very different beasts. I want to go through some things regarding the different ways that you can actually go through the budget process, and certainly we'll give you some recommendations there on what we believe is the best way, particularly for engineering firms and also for just small business best practice. So we'll go through those. We'll also look at budgets and using the budgeting process to tie that in with strategic planning, because the two definitely go hand in hand. We'll have a look at the bank's views of budgeting and what sort of things they're looking for in case you are looking for finance, and we'll consider some other benefits going through the things that I'm about to show you in this particular webinar. We'll look at some key performance indicators, and there's a couple there that I think particularly for engineering firms that they need to be looking at as part of their strategic planning process. And again, if you have any questions, please put your hand up and using the GoToWebinar, or if you're having any problems, please let us know so we can actually act on those. Right. Okay. So when we talk about budgeting, you're probably thinking, well, what's all the fuss about? Well, believe it or not, many business owners don't believe in budgeting. Quite a few do. But when I speak to a number of different firms or small business, they will talk about, look, Peter, that's great. I'd love to do a budget, but to be honest with you, at the end of the day, I pretty much know what's going to happen over the next 12 months. And regardless, I don't really see a lot of value in it because you can't predict the future. So what's the point in doing a budget when in reality things are going to change? And I can understand that pushback. However, what businesses need to understand is that if you don't understand how a budget ties in terms of revenue expenses actually affect your monthly and yearly bank movement, then what will happen is that you'll often find yourself wondering where all the cash is. So once we can get that, I suppose, show the benefits, educate the clients so that they get a good handle on how the two and an understanding, because at the end of the day, I fully appreciate that business owners and engineering people, very smart people as well, don't worry about that, but if it hasn't been explained to them, then they probably don't see the benefits of it. Once you get a handle of it, what we find is that it'll help you to start to think of ways to not only improve cash flow, but also start thinking a little bit outside the square, bouncing ideas off your business advisors, trying to figure out how you can actually improve your overall business performance. In the past, and I think it's fair for us as an accounting profession to put our hand up, because I know certainly we were guilty of this probably until about 4 or 5 years ago, that typically accounts are done, financial statements, tax returns, a meeting is held with the client. However, there's very little discussion in ways of improving the business. There is more a discussion about, well, this is how much tax you have to pay, or you don't have to worry about this year. But explaining to the clients where the cash is, where they've made a profit, and how that ties into the result, and more importantly, how they can actually improve not only their bottom line, but improve their cash balance. So that's the way our profession should be going, and it's something that we're very passionate about. And going through this process today, I'm hoping I can get you to see the reasons why we think this is such a brilliant process, because we have actually done it for ourselves as well. Okay, so P&L budget versus cash flow budget. We often hear the term, look, you need to do a budget. And I think a P&L budget and a cash flow budget are a term, or the term budgeting in itself is very loosely used, but there are, the difference between a profit and loss budget and a cash flow budget are, it's quite substantial, and they are two very different beasts in my opinion. However, of course, they do tie in with one another. So a profit and loss budget, a profit and loss budget refers to budgets for revenue expense items only. Okay, so it doesn't include things like the timing of when your revenue and expenses will actually hit the bank account. So you might find that you're actually invoicing your fees out to the clients, but they could be taking anywhere from 14 days to 2 months to actually pay you. Similarly with your expenses, you'll be paying your your different expenses out. However, you might have 30-day trading terms, you might have longer, but a P&L budget won't actually take that timing into account, and obviously that affects your cash flow. P&L budgets do not include GST. That is, of course, unless you are not registered for GST. Most businesses are going to be registered for GST. So if you look at your profit and loss statement that your advisors give you at the end of each year, you'll notice that the P&L does not include GST. So a P&L budget will not include the goods and services tax. A P&L budget does not include capital repayments, such as principal repayments, only the interest. And it won't include other repayment plans that might be in place. So, typically if you have an arrangement with the ATO to pay income tax or GST, and hopefully as a result of after today you will not need to go down that track in any case, then a P&L won't actually show that. It might show some interest if you're paying that. It won't show also monies introduced, such as loan proceeds from your bank, or if you have to tip money back into the business to give it sufficient working capital to keep working, to keep going, or your drawings or dividends. It won't show those things. However, a cash flow budget is something that is obviously it's quite markedly different. So it will take into account the income and expenses that you're bringing in, but it will factor in the timing of when the revenue expenses actually hit the bank account. So you need to have an understanding of how long it's taking for you to either receive your monies from clients or actually paying. It takes on average to pay your bills. It will take into account GST received, so when you actually receive your monies that include GST, a cash flow budget will show that. Sure, it will show BAS payments at the end of the quarter, or if you do it on monthly, at the end of the month, and it will take into account capital repayments such as principal, and it will include the interest as well, and other repayment plans, and it will show timings of when you expect that you might introduce monies either from the bank or yourselves, or whether you take out dividends or drawings depending on your structure, each month. And it will take into account, I suppose, level of work in progress or stock movement. So a cash flow, if you're taking a long time to actually get your bills out because there's a lot of stuff sitting in WIP, then when you're actually factoring that in, you not so much the stock movement, but levels of work in progress. Obviously, unless you have a standard interim billing process, then the work in progress is not actually going to be billed until it's completed, and then there'll be typically a time frame for getting that money in from your clients. So why do we need to consider doing both of these? Well, just to give you a very simple, I suppose, graph or tool of what we actually do when we sit down with our clients at the end of each year. Clients will sometimes look, and we go through the results, and they say, well, look, I've made a profit of 50,000, say in this particular case, but when I actually look at my cash balance since last June, or the end of last year, since the 1st of July, my bank balance has actually gone down by $24,000. And Peter, I don't really understand that. Could you just explain to me where the money is and why, if I've got this profit, I don't seem to be to have any cash flow, or the cash balance is not as good as I thought it would be? So what we'll do is we'll say, well, look, the business has generated $50,000 worth of cash to start off with. Included in that profit is an expense item called depreciation, which is, as you know, most of you will be aware of, wear and tear on assets. It's a book entry, it's not a cash flow item. So therefore that needs to be added back. So all of a sudden I'm looking at $75,000 that the business has generated, but I'm trying to find out where it's actually gone. A dividend was taken in 30 June of 20,000, so that needs to come out of that. So okay, we're now sitting at 55,000 of cash generated after dividends. And stock, this could be, typically work in progress as well. If it's increased by $30,000, then that will actually bring the accounting profit back down again, so that now sitting at 25,000 in surplus cash that we would expect our bank balance to increase. Our debtors have actually increased by 50,000, so we actually haven't received the money since 1st of July on. It's actually increased by $50,000 from the balance at 1st of July to the balance of 30 June, so that's going to impact on the profits that we've generated. So now we're $25,000 down, but by having a look at the creditors, we note that we actually owe more to our creditors at 30 June than last year by 49,000. So now we're sitting at 24, and there was some extra tax that we owe that we haven't paid yet compared to last year. So our bank balance theoretically should have improved by $26,000. However, looking through the bank or the balance sheet, we've noticed that the bank has actually been paid an extra $50,000 off our loan. So that needs to come off the cash flow. So therefore, our bank balance has decreased by $24,000 since 1st of July last year. So that's just to give people an understanding of where the cash has gone. And you can see that there are some things in there that don't relate to the P&L items themselves. So it's just to give them an idea on why they haven't got the cash flow that they may have expected. So let's look at an example of profit and loss budget versus cash flow budget and see what happens when we change a couple of assumptions. So what I'm going to call up here is we use a three-way budgeting model that we've been using now probably for about the last 4 or 5 years. Basically what it allows us to do is to work with our clients to help them to understand the difference between profit and loss and cash flow budgets, and also to give them what's called a three-way budget so that they can see what they're budgeting from a profit and loss point of view, how that is currently going to convert into cash given what they're currently doing in terms of collections and payments. And then also it does produce a balance sheet, and the three do in fact talk to one another, and they understand some of the things that affect the profit and loss will find their way into the cash flow, some won't, and the balance sheet will take into account profits and also capital repayments, etc. So if we look at this particular example of XYZ engineering firm, it has an opening balance sheet. So at 1st of July, if we were to do a budget working with our clients for the next 12 months, and sometimes we'll do a 3-year projection for them if they so desire. The software allows us to do that. And we will actually sit down and say, right, we need a starting point on where your balance sheet's at. And so your actual balance sheet before we do the projection might be sitting at $54,000 you have in your bank account. You might have debtors of $225,000. You have goodwill. You might have creditors of $286,000, some PAYG payable, super, GST, etc., etc. And that can all be gotten from your financial statements or from your accounting system that you use. So that's the starting point. What we'll then do is we'll sit down with our clients and say, right, let's start off with a profit and loss budget. Let's try and figure out what the profitability of the business is going to be over the next 12 months. So I want you to actually sit down and even if it's looking back through your past, let's use some of the past information through your accounting software to figure out on a monthly basis what you expect to bill each month. And again, you can use last year's or the current year's as a reference point. You'll obviously include things like fees, what you expect to bill out, what expenses you think will be there. You might put them up a little bit, and that's no problem. You will put all those in, and once you've done that, we'll sit down and have a bit of a discussion, and we might say, well, look, okay, your profit before income tax after interest is currently sitting at $1,078,000. It's before drawings. And you'll pay tax on that of about $323,000. So your net profit after tax should be $754,000 in this example. A lot of owners might think, well, that's fantastic. So how does that actually convert to cash flow? So let's have a look at currently once we've put that in. And if we look at cash flow based on debtors that were owed at the 30th of June, based on assumptions on how quickly we get paid, which I'll talk about shortly, less some other costs, less GST, less loan repayments, and less a dividend or drawings, you're actually, your net outflow is going to be $10,857 is actually going to go out of the bank account. So where you might have looked at the P&L and thought, look, my bank balance was 54 at the start of the year, it's gone up $1 million. Yes, I've taken drawings. I've had a profit of $1 million, but why hasn't my bank account balance actually increased by the same amount? And you'll say, well, right, okay, well, there's a number of reasons for that. But let's go back in and have a look at your P&L, budget. And let's, having looked at your previous key drivers on what's happened in the past, we've looked at your fees. And we've noticed that it's taking on average for you to get paid 57 days, believe it or not. And occasionally the owners will say to us, no, well, that doesn't sound right. We definitely get paid quicker than that. So, well, okay, well, let's have a bit of a look at it. And there is another way there. You can do a calculation, which is basically your average debtors divided by total fees for the year multiplied by 365. And there can be some timing issues, I suppose, at the end of the financial year, but we would actually check the average calculation by looking back at a couple of months balance sheets and debtors at the end of the month, look at your last 3 months billings and just see how long it is taking for you to get paid for those last 3 months billings, just to get a bit of an idea on the number of days it's taking for you to get paid. So we said, well, look, it's taking on average, you take 57 days. So we've worked out, and we've also noticed, by the way, when we actually sat down and talked to you, we've noticed that you are invoicing evenly, so you're doing them virtually daily. Some businesses do them at the start of the month, some of them do it in the middle, some do it at the end. But if you're doing it evenly, well, all these sorts of factors can have an impact on calculating when your money is going to be received. So you'll see here that the model's saying, well, look, we expect your fees to be $3.2 million for the next 12 months. However, because it's taking you on average 57 days to get paid, the actual monies you will receive in terms of cash receipts is $2.9 million, and you'll have a closing debtor balance of $606. So we will then sit down and say, well, look, we need to work on this. We want to improve the cash flow. We need to have a bit of a plan on how we're going to actually improve the cash flow. Is it that we're not getting our bills out quickly enough? Is it that we don't price up front for our clients so that they have an idea? Because typically people that don't have an idea on what the fees are going to be, they usually wait. It becomes a surprise, then they hold off, and then some people even wait till it's due. Then they ring up and say, oh, look, John, would you mind just explaining to me how you come up with that bill, because we weren't expecting that, we're not very happy, and we just can't find the money straight away. You can look at prepayment discounts, which can be a number of different strategies that we can work with you to figure out how to do it. It could be that you need to just simply change your trading terms, a number of different things. But if we say, well, look, that number there, we need to get that down quite substantially. If your current terms are only 30 days or they're 15 days, for example, why is it that you have 57 days? We need to try and fix that. So if we change that number from 57 to 40, and this is going to be the target, and sometimes what we'll do is we'll allow the number of days for while the new strategies kick in to improve cash flow, and then we'll save and close. And then what we'll do is we'll say, well, look, if we can get our debtor days down to 40, and we're going to monitor these monthly with you or quarterly, or we want you to look at these sorts of things, you'll see that the profit and loss hasn't changed one little bit. It might change for if you had interest, or if you had loans and you could actually pay off some of your debt more quickly. But what's it done in terms of cash flow? Well, if you remember last time, we actually had $54,000 sitting in the bank at the start of the month, so it started the year, and there was a net $10,000 outflow of cash just by changing the way that you are billing, the way you're getting the bills out, and it could be to do with work in progress, etc. Then by getting your debtor days down and putting in a few strategies to get paid more quickly, all of a sudden you now have $224,000 sitting in the bank account. Hell of a lot better than where it was before. So it looks very simple, and yes, you could argue, well look Pete, all you've done is you've just gone in and changed a couple of numbers to make it look good, but the principles stay the same, and you need to be on top of these sorts of things. You need to be able to make sure that the cash flow is taking into account non-profit and loss items as well, for a number of different reasons. This three-way budgeting model also produces as you change in drivers in the profit and loss and in cash flow, it actually updates the balance sheet as well. So you'll see that 224 at the end of the year is starting. It will be there at the end of the year. There's the start, and along the way it'll give you a snapshot of what your balance sheet should look like. So, so hopefully you can see, the effect on cash flow and by looking at different things. You might also want to have a look at how you're paying your suppliers as well. In this case, we have subcontractors, and they usually like to be paid as they go. You might have a situation though where you, give them some, or they give you some trading terms, but the model can actually go in and be changed. Same with consulting fees, etc. And as part of the planning process, all of these things need to be taken into account. So a very big turnaround just by having a focus on how the money that you're generating converts back into cash. Okay. So why is it important to look at both P&L and cash flow budgets? Well, first of all, we want to make sure you're making a profit. It's not don't have to be Einstein to work out that if you're not making a profit, unless you're expecting a bad year, you're a startup, then without any capital injections of funds, we're going to run out of money, and that's obviously not good. But having established that the business has an ability to generate a surplus looking forward, and having looked at past results, we need to ensure that we're making enough to cover our non-profit and loss items, such as bank loan repayments, drawings, it could be for school fees, or etc., or investments outside of the business. And if we can't see that the business is generating enough surplus to cover these repayments, then what's the point in actually going on? Because we're just kidding ourselves and we're always going to be struggling. So if we can figure out that we're not making enough, then we need to go back into our three-way budgets. We need to start off with our profit and loss. We need to start doing what-if scenarios and trying to figure out, well, what would we need to bill in order to get this covered, and what effect will it have on our cash flow? How can we actually, if we need to grow our business and improve the profitability, if it's through growth, for example, not just reduced overheads, then how quickly can we convert those dollars into cash, and do we have the setup in place to make sure that happens? If we're going to allow for growth, of course, when we're doing our modelling and future, we need to allow for extra, maybe wages, subcontractors, etc. It could be extra marketing costs. So, what are the different budget processes? And I'd like you to just perhaps pause and have a bit of a think on how you currently do your budgeting. Is it just looking at last year and adding 10%? And doing a P&L budget, or is it a genuine cash flow budget? And look, and if you are doing that and it's working for you, I'm okay with that. What I'd like to just go through now is say, well, look, typically if someone does that, they'll say, look, let's just add 10% to revenue and expenses and see how we go, and that's fine to start off with. I would suggest that you still look at the balance sheet and determine what's happened to the profit and loss figure in previous years, and determine where the final resulting is sitting in terms of cash flow. Okay, so you can actually adapt that to your projections. Do things like debtor day calculations, cash lockup, and look at your work in progress with your team. Are they getting, what are the average work in progress days? What are the average debtor days? And get a bit of an idea, because that needs to be factored in when you're doing your budgeting, and check that it all makes sense. The differing budget processes, I suppose the second one that I think is very powerful, and one that I would recommend that you consider, and that is using the budgeting process to make real change. So what you would typically do is we do an analysis on what's happened in the past. Again, we'd still do that. We would then sit down and say, well, look, how much do you need or do you want to have in your bank account within 1 year to 2 years to 3 years? And some of it might be in terms of profitability, because you might be looking at selling the business both internally to existing team members or to an external party. But also you might want to have a look at and say, well, look, I want to, it's just too tight. I don't want to actually have that much money in the account. I want more, or I want to take more out of the business. So that's okay, but so you'll need to start thinking, well, righto, well, let's work on the three-way budgeting model, and let's go, well, how much do we need to increase our revenue to get to where you want to get to? Does it mean we need to increase price? Do we need to increase the number of clients? Do we need to improve the retention rate of our existing clients? We need to have an understanding of these, and if you haven't, that's okay. We would actually sit down with you and show you how to do that. Reduced overheads where applicable. By all means, go through all your supplier relationships and see if you can get a better deal and source it, see what they'll do. It could also mean that you might be able to negotiate some improved supplier terms or trading terms so that you're not paying them as quickly. But again, if you are going to increase revenue, just remember that you will need to consider overheads that might have to rise in your budgeting, whether it be for marketing, new employees, etc. Recalculate your debtor and supplier terms, doing what ifs. So if you could get your debtor terms down or your debtor days down, what does that have effect on your cash flow? Does that get you to where you want it to be? And if it does, fantastic. That's the easy bit. Now what we need to say is, well, look, that's where we've got to get to, and we've got the budget in place, but it looks good. We know if we can make these things happen, we'll be happy. But of course, those items that you've done, and you've started the process very well, but they're not just going to magically happen. You need to have a plan, and this is where we talk about using budgets to hold strategic planning sessions so that you can give yourselves the best possible chance of achieving what you need to achieve. And how do I know this? Because we've done it ourselves, and we've done it very successfully. So the process works. It does involve a bit of work, but once you've got it up and running, it really will allow you to start thinking about how you can improve your cash flow and improve your business. So by looking at a detailed analysis of the past, again, how many clients did you have? What was their average spend? How many times are they spending with you? What effect would a level of price increase have? Would we lose some? Would we keep them? Where are if we need new clients, where are they? What do they look like? How will we get in front of them? So what sort of marketing are we going to do? For any new leads that we get, how are we currently converting them? What's the percentage? Can we improve it? Do we need to train our team and ourselves on selling skills? Because at the end of the day, if we're in business, we are all in sales, and a lot of professionals, including accountants, fail to understand that. How productive are our team? Can we improve the percentage? So, obviously, being a professional service firm, what are the current levels of productivity? Can we improve that percentage? Again, how many clients did we lose? How do we reduce that? Is it something like customer service, or are there things that we're doing? Did we survey our clients when they left? Was there a reason? Was it because we were too dear? We didn't communicate? We didn't finish the job on time? Was a team member rude to them? Was it just a whole level of miscommunication? There's many things that can be looked at to really improve. All these tie in with how you can reach your targets and with budgets and whatnot. So very, very important in terms of having a strategic plan. And to give you a bit of an example on some of the things that we do once we've done this with our clients, is that we will run through, say, a one-page strategic plan, which we'll give to our clients. We'll help them fill it in, We use what's called as the Gazelles system, which is a guy called Vern Harnish that I saw about 2 years ago now, and it's a one-page strategic plan. It's basically an Excel spreadsheet that can be put on A3, and it will actually have targets for the next 3 years and where we want business to go to, goals for 1 year, and what are the key positions. And obviously these should tie back into your three-way budgets, which we make sure it does. And you'll see we talk about the number of full-time equivalents in our team, lock-up days, number of clients that we have, what is the average project value, how many times do we do work with our clients, what's the average revenue per client per year, and what's the revenue per full-time equivalent, etc. You'll see one there that is an average hourly rate for all full-time equivalent team members. This is something that we look at very carefully because we know that there are some non-chargeables, but if those non-chargeables can actually assist in getting things ready for the professional team so that they become more efficient, that they can get through the job quickly, if we can improve this number and see that it is improving, it can have a massive effect on our bottom line. Yes, the average hourly rate recovered per client, and that's purely the number that the fees that we've charged to time charged to WIP on jobs completed. If that's going up, that's great. But the average hourly rate per full-time equivalent team member is the critical number that you guys need to be considering. What are our quarterly themes? You know, and we would recommend, and this is somewhat controversial to some, but we would recommend that once all this is developed, your professional team and even your admin team, we would suggest that you consider sharing the numbers with them. Not everyone's cup of tea. It's not going to be the end of the world if you don't. But if you want to get team buy-in, what you'll typically find is that they thought that you're probably making a lot more anyway. Obviously, there's a degree of trust, but if you want engagement, you need to let them know what the big plan is. So what are your core values? What's your purpose? Why are you in business? What are some of the actions that you need to do to make these numbers happen, both over 1 year, 3 years? What are the key numbers for the quarter? So we will actually have this, and you will put the numbers in. It's obviously a process to get to where you want to go to over the quarter. However, you also will then need to update it. Just these areas need to update these areas so that you have new focus. Then hold a meeting with your team and go on with some action plans, etc. And meet regarding these regularly, which I'll talk about a little bit later. So it's pretty powerful planning tool. Definitely, when we help our clients, we actually will show them how they're actually going to get there, and in the sample it might be that you want to be BHAG, your big, hairy, audacious goal, and your vision for it might be that you want to be the engineering firm of choice and take over, 20 or turnover of $20 million, etc. It all depends what you want as owners. So, but all of these should tie back into your three-way budget. Okay, so we also, with our engineering firms, actually when we are looking at, how much how they've performed in the past, we'll put in some key numbers. We'll look at, what they're currently doing, how can they plan to get their revenue up to where they want to get it to, what does the future plan look like, and what average hourly rate are they hoping to get to. And again, this will all tie in as part of the strategic planning. We'll look at the key average hourly rate. In terms of the revenue planning, we look at business groups, we look at fee earners, we look at client groups, etc. We look at productivity, and we look at the effect on what additional costs we'll need. So this is all part of existing services to existing clients, and how whether we can, with some efficiencies, we can improve that. What will that do to the number of hours we need with our engineering business? What can we actually do with existing clients, new services? What are we recovering at the moment? And of course, for new clients, existing services, what will that do? And it'll all turn into how many extra hours we need. So what are the actual levels of staff we need, etc., etc. So all very, very good, and that's all part of the process. There is a monthly dashboard which we keep an eye on with the clients, and we go through that as part of our monitoring sessions with them, and we keep them accountable for some of the key areas that they're trying to get to. So Very, very, very simple, very, very powerful, and very, very effective. Okay. So I don't think we have any questions at the moment, but if you do, please put your hand up. Okay. So that's a little bit of how you can actually use budgets with your strategic planning. So, just to summarise that area, like you should understand first of all what's happened to your business in the past. Definitely do a three-way budget, thinking about what it looks like moving forward. Perhaps saying, well, look, this is where we think it's headed the next 12 months. But then have a bit of a think and work backwards on how you want it to get to once you've looked at your cash flow and profitability. Go back in and adjust the three-way budget so that it reaches your expectations in terms of cash flow, profitability, and business performance overall, and then finally hold a strategic planning session to make it all happen. You need to do that. You can do it yourselves. There's no reason why you can't. If you need assistance with that, then your advisors and we would be able to help you and assist you in that area if you needed it. All right. So bank's view of budgeting, well, some of this might be fairly straightforward, but there's no doubt that when a bank is looking at your business, they obviously like to see budgets. They typically want to see that at when they do the annual review, where you have borrowings either within the business or outside of the business for your investments, etc. Banks, once they've seen that you've gone to this level of detail, that they can see that there's a better planning for a better business. So it makes their job easier when trying to make decisions about what they can do and what they can lend you. If there's going to be a shortfall in cash flow as you work through your monthly cash flow that I showed you, it'll show that if you can't fix that for whatever reason, and it's going to take time to fix that, or if it's only a temporary thing, you're letting them know in advance and saying, well, look, in 6 months' time, in December and January, we're actually going to go through, we're going to be short cash flow. We've only got an overdraft facility of 100 grand. It looks like we're going to need 300, but we can see that things with the way we've planned that will come good. But we need to just let you know that we are going to need a cash injection or an ability to draw on an overdraft. They know that the risk of loan defaults are greatly reduced. And once you start getting into that territory, they start to think, well, look, these are clients we want to keep. So therefore, we might have to sharpen our pencil on how much interest we're going to charge them, because typically you are then in a position to say, well, look, we've done our planning, we have a planning process that will greatly improve the performance of the business, and therefore we believe we are going to be at much less risk of obviously being a risk to the bank in itself. So we would like to bargain a deal with our loans and how they're structured and interest rates, etc., etc. Obviously, any business case that's put forward, it's not just a P&L budget that's shoved in with an application form, having it detailed, and then even better if you have a strategic plan, even better. But it's much easily or more easily explained so that they can see that how you're going to make the numbers happen. You can put a P&L budget in there and maybe put a couple of notes, but it doesn't really explain. If it looks the same as last year, they might run with that. But if it's looking very much better, or it's looking much better than what you've done in the past, so they're going to want to know, well, how have you done that? What have you done to improve that? And have you considered cash flow, which you will have. So they have comfort that the business owners understand the difference between profit and cash flow budgets and what the key drivers are. So I hope that it might have all been quite straightforward to you beforehand, but going through a better planning process and doing it in this detail really does give you a much better chance of negotiating with your banks and being prepared in case you need extra funds. Some of the other benefits of going through the process of three-way budgeting, or with the advent of cloud computing, for example, MYOB Live Zero, SASU, we've worked with all these with our clients. Once these budgets have been set, they can be input into these applications, and you can monitor these monthly, quarterly, 6 monthly. Yep, you can do that in the desktop version, but by putting them in to your cloud options or your cloud computing system, you don't have to worry about your accountant asking you to send you through a file and stop working on it so that they can figure out what's going on, or printing off a whole heap of reports that need to be sent in. Your accountant can look at and dial in and have a look at what your system says more easily, and so that means that the holding of monthly or quarterly meetings have never been easier, and that means that to offer a quicker and better way to offer a board meeting process, as if being a fellow board member, you really should be finding that your advisors are now jumping in and trying to assist you with some of the key numbers and how they compare budget versus actual, and what action plans need to be put in results. So typically when I work with clients of ours, I'm looking, or clients that we take on, I'm looking at being as if I'm a fellow board member. If this were my business, or if I were a company that I was a board member and I was expected to put input, what is it that this business needs to do? How has it compared to what it planned and budgeted? It's going to be much easier for me to advise if that process has happened, and then what needs to happen next quarter, and what action plans in place to make sure that we're getting closer to the goals and getting back on track. I should just say also, it goes almost without saying, that businesses with better cash flow will typically be valued higher. Certainly when we're looking at valuing businesses, cash flow is a big factor. We look at how they budget, we look at how professionally they have worked out where they want to get to and the detail of level that they've gotten to, so that if clients of ours are looking at buying, then they can generally get a bit better feeling that if there's much better cash flow, then it's a lower risk, so therefore you'd be prepared to pay a little bit more generally. If you can see that the business is cash strapped, always struggling, it's probably going to mean that the purchasers or prospective purchasers are going to offer you a little bit less because of the perceived risk, and there'll be some cleaning up to do once they get in. So you need to act on these sorts of things. Some key performance indicators, well, I've gone through some of those already, but certainly debtors, days, WIP, gross profit margins, and with professional service firms, we would typically take off salary and wages and subcontractors where they're actually doing the work, when we work on a gross profit margin using salaries and wages and contractors, and obviously materials. If you're an engineering firm, we take that into account as well. Profitability is definitely a key performance indicator, of course. Wages as a percentage of revenue, supplier days, how long it's taking us to pay people, the hourly rate per full-time equivalent, which I discussed, which is a critical number, one that we really do focus on with our clients. Average hourly rate recovered per client, that is purely the amount of bills that have gone out, excluding GST, divided by the number of hours charged to WIP on those jobs. And director productivity. Have a look at your director productivity. Sometimes, if it's high, okay, that can be okay, but typically those directors that are working, 80%, 90% of the time, which they sometimes love doing when there's nothing wrong with that per se. However, that typically means they're not spending much time on the business. So either you've got to consider about if you're not going to work on the business as much and you want to keep doing the work and working in the business, then you might want to consider employing a business manager, or just having, probably means that you've got to be even more careful about having some of these plans in place. Otherwise, you're just going to be working for many, many hours and doing twice as much work for half the result of what you could have done. So, where possible, I would suggest that director productivity should be, this is a bit of a generalisation, but usually less than 50%. The other 50% could be to do with working on the business, making sure that you're looking ahead in terms of planning and getting the work in, monitoring what's happening with the KPIs, which is definitely what, some of the things we've just gone through. And it could be about getting out there and seeing your clients and having discussions with them for free, just meeting them, because the old story that the more often you contact them and you get on the front foot, that often leads to new work that you mightn't have got if you hadn't have just jogged their memory. Plus, it's a good way of keeping them and staying in contact with them. So certainly you need to look at those things as well. Value improvement program, this is something we look at with our clients. We'll do an initial business valuation assessment of businesses that we deal with. We might say, well, look, this is approximately what your business is worth now. We'll look at other businesses. We'll also look at future maintainable earnings, and we'll do a SWOT analysis. We'll then work out and find out from our clients how much they think that it is that they'll need to retire, and whether the business goodwill will be needed to help fund their retirement. And if there's a shortfall from what the business is worth now to what we think it will need to get to help fund that retirement, we'll call that a value gap analysis. We'll look at then saying, we'll look to optimise your profit. These are the areas that you need to work on, and these are some strategies to look at. We'll use benchmarking, which is a number of different benchmarking reports. One of the ones we look on an overall basis is IBIS World, which we subscribe to. We have unlimited access to those benchmarks reports on perhaps an overview, and there's some very good engineering ones in there as well. Very good publication, and good to have, and for clients to at least see and understand where the industry is headed. We'll then say, well, look, if the business is revalued at this is where you want to get to, then this is how much the value in your retirement gap, if you're using your business proceeds, will be, and this is where you're at now. But these are the strategies you need to do for growth, improvement, and part of your succession plan. So it's an overall, I suppose, thing that some businesses do like to have a look at. In a perfect world, you would look at, and you would look that far ahead. Not absolutely compulsory, but good to start thinking about some of these things. So that pretty much comes to the end of the presentation. We do have a special offer for those that have attended today, and for those that have actually attended the webinar, for the first businesses that contact us, they'll receive, and Jackie will have the forms emailed to you all. And the first 10 that actually fill those in will review your current budgeting processes and make recommendations for improvement. That's valued at $350. We'll do an analysis of where your business's cash has gone for the past 3 years and explain that to you, and put that in a report valued at $550. We'll do an analysis of your business's key drivers and a recommendation of which ones you need to focus on, which is valued at $650. And we'll do a business valuation assessment, which is giving you an indication of where your business and how it might be currently valued at the moment, so that you've got some idea where you are now, and get you start thinking about where you need to get it to if you do improve the business. So that's a total value of $3,050 plus GST, for an investment of $280 plus GST for the first 10 that actually contact us and fill in the forms and get those back to us. We will go through those 4 items above for you, for the princely sum of $280, which believe me is very, very cheap. So I believe there'll be a link to the website, but we will actually email those out to you. So in conclusion, for the webinar, we'd like you to perhaps consider your own position. If you feel that you'd like us to meet with you or and help you with some of these issues, and help you to confirm, understand and confirm your needs, objectives, and how we can help you secure your future, please let us know and contact us via either the website. All the details are on there. I hope you've enjoyed the webinar today and that you have got something out of it. I am passionate about this whole process. It is something that has worked and improved business performance for ourselves and other business owners quite dramatically. And for the little bit of effort, once you're on the road and you've got a good understanding of it, it's easier to do each year, and it's easier to keep track on where you are, because we all work too hard, and a lot of us will put our houses on the line, and if we haven't done this process and the planning, whether you do it with us or whether you do it with someone else or whether you just do it on your own, that's fine. However, you need to do these things, and as I say, it's something I'm very passionate about, and helping firms move forward in the right area and assist them along the way. So thank you for your time. Please, I hope you've enjoyed the webinar, and if you have any other questions, please contact us and enjoy the rest of your afternoon. Thank you.